Hello and welcome to The Road Already Traveled, a podcast where we feature lessons from successful entrepreneurs and the professionals that serve them as they share their inspiring stories and insights. Now, let's get started with the show.
Hello, I'm Rich Schutte, your host of The Road Already Traveled, where we share lessons from entrepreneurs, like-minded business owners, and the professionals that serve them, providing valuable insight to those listeners who are on the same journey. This episode is brought to you by Avalan, a wealth management firm dedicated to personalized financial, business, and investment planning for entrepreneurs as they make their way in our chaotic world. Are you ready to take control of your financial future? At Avalan, we believe wealth isn't just about numbers. It's about freedom, security, and living life on your terms. Wherever you are in your entrepreneurial journey, our team of experts is here to guide you every step of the way. No cookie-cutter solutions, just smart, personalized strategies designed for your goals. Using our unique Optimal Entrepreneur program and an unwavering focus on world-class service, our relationships are built to last generations, helping clients achieve lifelong goals through a thoughtful, consultative approach. Visit avalanwealth.com today and start building the future you deserve. That's AVALAN wealth.com. Well, today we are joined once again by Avalan's Chief Investment Officer, Peter Madlem. Peter, as you may know from previous listens, is an investment strategist, spanning decades, and has been with Avalan now for the last many years, helping guide our thoughts and portfolio construction as we manage markets for our clients. And as we've been trying to do on a quarterly basis, we're welcoming Peter in to chat about his musings around markets and portfolio thoughts and just the general financial world around us. So, Peter, welcome back.
Thanks, Rich. It's always fun to do these pronouncements. It forces you to focus and get rid of a lot of the noise. So I'll start by welcoming everyone to the final quarter of the year. We have markets posting all-time highs amid conflicting economic signals, a non-functional government, and two dangerous wars. So what the heck is the market discounting? The market's discounting the ongoing resilience of the economy and corporate earnings. It's discounting that the odds of a recession over the rest of the decade remain low. And the longer the economy is expected to grow without a recession, the more sustainable high valuation multiples can be, because earnings growth will be expected to justify those valuations in the future. High valuations don't cause bear markets. Instead, recessions cause bear markets because they depress both earnings and valuation multiples. And corrections occur when widely feared recessions cause valuation multiples to fall. However, those multiples quickly rebound when the expected recession doesn't happen, and that allows earnings to continue growing. We experienced that phenomenon this year, February, March, into early April. The S&P 500 reached all new highs in the third quarter as the markets continued to be supported by strong corporate earnings and enthusiasm for artificial intelligence. At the same time, the labor market showed surprising weakness over the summer, and that raised concerns about the financial health of consumers. Despite this, GDP growth has been strong and inflation has largely stayed in check. Speaking of AI, Jeff Bezos appeared on stage at the Italian Tech Week in Turin, Italy last week, and he was asked whether AI is a bubble. And the Amazon founder said that this is a kind of industrial bubble. And he told the audience that during bubbles, every experiment or idea gets funded, and the good ideas and the bad ideas. And investors have a hard time in the middle of this excitement being able to distinguish between the good ideas and the bad ideas. And that's also what's happening today, notwithstanding the speculative excesses. Bezos also affirmed that AI is real, and I concur. And it's going to change every industry. The bubbles that are industrial are not nearly as bad. They can even be good, because when the dust finally settles and you see who the winners are, societies benefit from those inventions. And that's what's going to happen here too. This is real, and the benefits to society from AI are going to be gigantic. That all makes sense to me. We can do a quick, round the table for the market and economic drivers in the third quarter just ending. The S&P, NASDAQ, Dow Jones.
Actually, Pete, if I could interrupt you, and I want to hit those around the horn numbers with the end of the quarter, and I'll bring you back to that. Mm-hmm. But I'm curious on the bubble thing. You made a comment, right, about when there's a bubble, there are people that are investing in good, bad, and ugly. And then there's also typically a recession that's involved in a bursting of a bubble. So I'd imagine most of us are listening to this, can think back very clearly to several over our lifetimes, right, which have been interesting, how many we've seen over the last just, 25, 26 years. But going back to that tech bubble that we saw, that formed in the late 90s and then burst in the very early 2000s, can you compare or contrast a little bit between what was going on then and what was going on and what is going on now in terms of how maybe it actually isn't the same thing that many are afraid that it is?
The dot-com bubble. And that was one of the anecdotes that I have that I think sums up the dot-com bubble, and we can talk about how it differs from the AI possible bubble. They are different, but the psychology behind them is related. The anecdote I had a woman who was recently widowed and had been managing her assets. And she was disappointed that we weren't in all of these dot-com companies, because at that point, anytime the internet was just rolling out of academia into the general populace, and anything with a dot-com after its name had money just being thrown at it, and returns were ridiculous. And she told me that she wanted to have more exposure to the future of the economy and communication, and therefore dot-com companies. I can't do that. It's not appropriate. So she pulled her account and bought a portfolio of diversified dot-coms. Well, we all know what happened. And I always felt terrible about that, because I couldn't convince her the sensibility of a diversified, sensible portfolio with a small component that you can take advantage of thematic trends that are emerging at the time. So here in the current AI is real. It's happening. It's not just a moniker after the name of a potential company. AI is real. It's actually impacting our business here at Avalan, whereas in the investment department, we do use AI primarily for administrative tasks, but for portions of our screening, it's very, very good at doing those types of repetitive tasks. And it even can occasionally uncover opportunities that we just missed because they seemed obvious and we didn't really dig deeper. So this is different. This time AI is real. We have building out of infrastructure globally. This is an interesting side point, Rich, because Jeff Bezos at that same conference, at the same speech, stated that he foresees solving the energy generation problem necessary for large language models and training them. They'll be done in space, where you have 24/7 solar energy, extremely low costs once you get the various portions of the edifice up there. And I thought that was very interesting, because he obviously has a vested interest. He has a rocket company, and so does Elon Musk. So that's their solution in terms of the energy needs. Within the decade, they say primarily all of the energy required for large language model training will come from satellites.
That's fascinating. So interesting. I guess Bezos's entry into space wasn't just to entertain Katy Perry.
Who's an astronaut.
That's phenomenal. So it is interesting, right? To your point, it's like, I know a lot of our clients, a lot of people that we work with are really starting to draw some connections, right, between the dot-com bust and what we're looking at right now. Mm-hmm. But it is different, right? It's like, and I looking back at it, I navigated clients through that period of time as well. And it was fascinating, right? When pets.com, I remember they had no business model and no sense of what they were doing, but the amount of money that they raised before they lost it all was astronomical, all mm-hmm. thinking that they could ship 50-pound bags of dog food for free and for less than what it cost to buy in the grocery store. Without anything else to ship. I guess at least they had a sock puppet when they wrapped it up that auctioned off at a pretty high multiple. I think it was the only asset that the company had left. Um, but yeah, this AI thing is real, and it is going to infiltrate our world, just as .com did as well. But I think we have a much different and clearer understanding in today's world what that looks like than what that unknown was in the late '90s.
We had a client, Rich, about a week ago that asked if we are using AI, and he's a former science teacher, and so he loves models, and became fascinated when he started working with Chat GPT 4.0. So he asked, "Are we using any models or AI models in the investment realm?" And I had to think about it because we are, but the ones we're using, we created the prompts ourselves, studied it for about 6 months before we gained a degree of accuracy. But in terms of the methodologies that we use, the intrinsic value methodology for individual securities, our fixed income and assessment across the spectrum of fixed income asset types, and looking at the mutual funds, the managers, the consistency of performance, all of the steps that we've used over the years to run those quantitative screens. Now AI does it for us. So that's been our primary adoption so far. But I know that the academia is looking at ways, and the professional organizations, CFA, SEMA, they're all looking for ways of incorporating AI more robustly in the investment management sphere.
Yeah, so AI is going to definitely remain the story for quite some time, huh?
Yes, it is. Yes, it is. It will be gigantic, the transformative power.
So I did interrupt you, and you were just about ready to kind of talk a little bit about what we saw over the last quarter as we entered the last of the year. You want to touch on that now?
Yes, I think the lesson to be learned from the markets this year, with all of the turmoil, we had tariffs, we had a very contentious new administration, contentious in the fact that it created all sorts of of problems between the two parties that we're now seeing now with the government shutdown. I think the tariff was the most, and then the reconfiguring of global trade, all of these things, plus fears of inflation and the interest rates, people thinking that they were too high. This and a plethora of other issues were a lot of concerns in the market. So a lot of people pulled out of the market. When you read the stories in the newspaper and look at the news and stuff, everyone wrenching their hands. Well, they missed one of the strongest snapback rallies in history. And in the third quarter alone, the S&P, the NASDAQ, the Dow Jones were up almost 11%, and over 5% respectively. And year to date, through the third quarter, NASDAQ was up 17%, the S&P up 14%, and the Dow 9%. These are pretty solid numbers for the year, despite the fact that we began the year with a pretty weak February-March period that once again rinsed people who don't have a long-term sense of the power of compounding that you can capture in the market, and washed them out. And they missed it. It's very, very important. And once you develop a strategy, you stick with it. And if you want to get an assessment, then you can look at valuations like price to sales, price to book, price to cash flow, which they're great assessment tools for where are we in a relative sense, but they are absolutely terrible at predicting future prices. They're terrible. And that's why at Avalan we use intrinsic value, which incorporates all of those price to whatever metrics. They're all subsets of intrinsic value. And we're looking at what's the value of forward earnings. Forward earnings are a very solid indicator of future price activity. So the price indicator also, since we're talking about price indicators, intrinsic value, which is the basis of our equity research, allows longer-term inflation-adjusted perspective, very similar to what the Shiller price-to-earnings ratio does, but on a much larger scale. And just talking about the Shiller, which I think is a very, very fine, because it is inflation-adjusted and it's a 10-year look back. The current ratio for the S&P 500 is 38 times, and that's way above the 35-year average of 27. So we are approaching levels seen during the dot-com bubble. But the difference between now and then is that earnings are incredibly strong for these companies, and GDP is surprisingly strong. And all of the concern about employment levels at 4.3%, we're still running at a very hot employment rate. we're starting to see it slow down. Technology stocks, which is what we hear a lot of people talking about, the valuations there as well. And they did across the sectors, they led the market up and then they led the market down in February, March. But the Meg 7 stocks now have risen 61% since the bottom. You had to be in the market. So investors are increasingly questioning whether corporate spending on AI will generate a positive return going forward. And the reality is that this has been a key driver of the broader market and business investment here for 2025, and it will continue into 2026. Let's stop right now, and I can just say that all year we've been saying that the S&P would close at 7,000 this year. We briefly raised it to 7,300, and now we're settling it back down to 7,000. But by the end of the decade, we easily see the S&P at 10,000 or possibly above. The renovation and the innovation that's going to be coming from the application of AI is truly astounding. We don't really know yet who the big winners are going to be, but we do have access to and exposure to the various different sectors of the AI environment. The Fed cut interest rates. This is all old news by 25 basis points. And according to the FOMC announcement, post that rate cut, they're between a 4.0 and a 4.25 range. Now, the was the weakness in the employment numbers, and I think that just essentially gave them cover to cut the rates. They were under a lot of pressure, but they will continue, despite the moves from the administration, they will continue to be a quasi-independent agency. And there's one other interesting fact, Rich, about this happening in the market now, as we start to enter the final stage of this particular run of the secular bull market. A measure of volatility is called the VIX index, the volatility index, and of the Chicago board. And after significant volatility driven by the tariffs and taxes and the problems going on in Congress earlier in the year, measures of economic policy uncertainty improved, and the VIX index of stock market volatility is hovering around 16, which is below its long-run average of 18. And the MOMVE, or the MOVE index, which is a bond market volatility, has declined to 78. That's about 11 points below its norm. But what's interesting about this is now 65% of all the activity on the VIX, which is supposed to measure the amount of put buying going on, portfolio insurance that investors are putting into place. Now 65% of the activity is in calls. In other words, people are buying volatility now. And it's very interesting. This is indicative of fear of missing out, that people don't want to miss out on this last vestiges of this leg of the rally up. And
really interesting.
Yeah. So one other thing I wanted to mention is that in terms of where is growth to be found, because our job primarily as wealth advisors is to capture the miracle of compounding, and the greatest compounding instrument in the world right now is the U.S. equity markets and the developed markets. And we need to design portfolios that fit the constraints and expectations of each investor to most efficiently capture that power of compounding. We want to lower the volatility band around the experience of the client and therefore capture, in other words, keep the peaks and valleys in a very narrow band so we can very effectively capture compounding. But for people who want to find out, well, okay, for a portion of my portfolio, where am I going to find these opportunities? And so Avalan does have a thematic portfolio that works very, very handsomely as a sleeve for the more traditional compound capturing portfolios. And some most impactful themes we're seeing now are gold bullion. And it has not crossed below its 200-day moving average for you techies out there since October of 2023. And that's the longest stretch of above the 200-day moving average since the great financial crisis. And global central banks have a higher reserve allocation to gold than U.S. treasuries. That's for the first time in my career.
Wow.
And stagflation risks are intensifying sort of behind the scenes. And so that's another reason possibly that investors are starting to acquire more and more gold. the inflationary implications of America's demographic cliff. That's my generation. And more and more as they retire, the structural disinflation of the past 40 years is probably not coming back. So who's going to do the work that nobody wants to do? And that's where AI comes up to the fore again with greater productivity. And so as the inflation adjusted price of gold breaks out to new record highs, the evidence of stagflation, we have to do now recognize that it possibly is there. Another huge theme, which we briefly touched upon in outer space, is the electric grid infrastructure. It's arguably the most important yet most underrated and underinvested component of global economic growth and technological progress. I think that a new super cycle of investment is unfolding as governments worldwide recognize the importance of grid infrastructure in staying competitive. And so I think one more, a theme that has been very successful for us here, the Avalan Thematic portfolio with all of the provisos, et cetera, but it's up over 30% year to date. And just investing in those particular themes, the demand for rare earth permanent magnets is underestimated by the markets. The key variable is whether the growing demand for permanent magnets will outpace America's current domestic production estimates. I think the answer is yes. And Gen Z now is more skeptical of government, and they're very fatalistic about the future than any other living generation before them. And so that has huge thematic implications as well. And these are the key or the core thematic opportunities that we've been exploiting here over the last 14 months in the Avalan thematic portfolio. So what do we see? We see the bull market continuing. Volatility will increase. And we look at 77,000 to 7,300 S&P 5 by the end of the year. We're moving into next year, going up into the 8,000s, and by the end of the decade, over 10,000. The economy is growing. The global tariffs that have been impacted now are reshaping global trade. We're onshoring. The interesting thing about the American continent is that it has more resources, a higher educated populace, and it's a landmass surrounded by water. Don't discount America, or the Americas, plural. That has a lot to do probably with the huge flotilla sitting outside Venezuelan shorelines. They have more oil. Venezuela has more high-grade oil than any other nation in the world, including Saudi Arabia. I mean a bit, perhaps jaundiced in that view, but when you look at geopolitical events, you also have to look at who wins and what are they after. Possibly that's one of the reasons we don't want it falling into hands of China or Russia, who have large investments in Venezuela. But looking forward, I'm very optimistic, but we certainly have to go through some very, very difficult transitions here, both domestically and in Europe.
Little takeaway that I have here, I've known you for a long time, and this is arguably about as positive as I've ever heard you view markets. But you also did talk a lot about volatility. And then, just because we're seeing, long-term trends going in a positive direction doesn't mean that there isn't going to be volatility and those sell-offs along the way. A challenge for investors I've noticed over my career has always been, when things are good, they always want to be a part of everything that's giving them the highest possible returns.
Right.
But, what you notice is that you can never keep returns. You can only keep dollars. And when those returns evaporate in volatile times, if a portfolio isn't positioned, well enough to be able to take those hits and keep dollars intact, a portfolio that sells off at 50% has to grow 100 to get back to even. So managing those bandwidths are really important. And that really does come into what you talked about previously, right? In terms of remaining well-diversified, having different asset classes represented while still having opportunities to find ways of enhancing the growth portion of your portfolio. So, it's a matter of being responsible. It's like you can't ask to have your cake and eat it too. Do you agree?
I agree. And for new investors and even slightly more seasoned investors, it's always tempting to say, well, look, I'll just trade off of moving averages. I'll avoid these sell-offs when they occur. And so maybe they'll pick a 50-day moving average or a 20-day exponential moving average. And if their portfolio or the market falls below that line for whatever reason temporarily, then they'll sell or go to cash, and then they'll buy in when the market crosses back over. I defy anyone to make that transition easily. I mean, I'm a professional investor, been doing it for a long time, and I can tell you that the very popular meme, buy low, sell high, easier said than done. And that's why, to your point, Rich, design a portfolio that fits your constraints and expectations and your horizon, and stick with it.
So for Avalan clients that are tuning in to kind of get a little take on what we've been thinking, thank you. If you need to talk to us more deeply about some of Peter's thoughts, or otherwise, you know how to find us, as we're always available. For those of you that aren't, and if you found something compelling that Peter had to say today, you can always find us through our website at avalanwealth.com. That's AVALAN wealth.com. And we can talk about things that are going on in your life. Interestingly enough, when it comes time for second opinions, we always want one. When the doctor tells us that we drink too much, we are carrying too much weight, or there's this tricky little problem with our heart, we always want a second opinion there. But we don't tend to seek them out in terms of looking at our portfolios. And that is something that we do as a service to anybody, is we will give a free second look or a second opinion on what you have, and to let you have your eyes wide open in terms of what you might be owning and what you otherwise might be able to. So, excuse me for losing my voice. Any questions, comments, or otherwise, again, you can find us on our website. If anyone wants to actually submit specific questions to Peter for his next quarterly commentary, you can do that through Avalan at avalanwealth.com. Once again, all A's in the Avalan name. So perhaps we'll get some listener feedback and questions as well for the next one. Peter, I appreciate you sharing your opinions, your thoughts. As always, they're interesting, and we'll see where we end up at the end of the year. We'll know in the next podcast how your 7,000 to 7,300 prediction on the S&P.
Yes, we will. All right. Thanks.
We're going to hold you to it, my friend. So for everyone, thank you so much for tuning in. Don't forget that we're available on all of your most popular podcast platforms, Spotify, iTunes, etc. Don't forget to subscribe and like and comment, and we'll look forward to seeing you in the next episode of The Road Already Traveled.
Bye.
As always, thanks for joining us on the Road Already Traveled podcast. We're grateful you've joined our community and look forward to seeing you again for our next installment, so be sure to click subscribe so you won't miss a thing. This communication is for informational purposes only and does not purport to be a complete statement of all material facts related to any company, industry, or security mentioned. This material is limited to the dissemination of general information pertaining to its diversified services. The opinions expressed reflect our judgment now and are subject to change without notice and may or may not be updated. The information provided, while not guaranteed as to accuracy or completeness, has been obtained from sources believed to be reliable. Financial planning, advisory, and/or consulting services offered through Avalan LLC, a registered investment advisor. Prospects or clients who take advantage of any free consultations or services are under no obligation to hire Avalan LLC as their investment advisor. Listeners who are not market professionals or institutional clients of Avalan LLC should seek the advice of their financial advisor before making any investment decisions based on this communication. Additional information on any securities mentioned is available on request.